Welcome to This Explainer. Today we're diving into literally the greatest financial mystery of 2026. We are looking at why Berkshire Hathaway, the legendary investing powerhouse, is suddenly hoarding a record-breaking amount of cash. Let's just jump straight in because the numbers we are dealing with today are absolutely wild, and the strategy behind them reveals a whole lot about where this market might be heading. Berkshire Hathaway just reported a staggering $397.4 billion in liquid capital. And that's just as of the first quarter of 2026. This marks the first quarter under the leadership of new CEO Greg Abel, who has officially taken the reins from Warren Buffett. But rather than going on some massive shopping spree, Abel has actually continued to pile up the cash, adding another $24 billion in just his first 3 months on the job. To put a number that massive into perspective for a second, $397.4 billion is literally larger than the total economic output of entire nations like South Africa or Hong Kong. It's an absolute ocean of liquidity, just sitting right there in the middle of a booming stock market. Which brings us to the big question we need to unpack today. As the S&P 500 continues to smash record highs, racking up some of its best consecutive years in modern history, we have to ask, why is the world's most famous value investing firm just sitting on the sidelines? We need to figure out why Buffett and Abel have completely stopped playing the game. So, let's get into section 1, unmasking the cash pile. Here is our very first clue. If you look at the years between 2018 and 2023, Berkshire's cash safely hovered around 30 to 32% of its investable assets. Pretty standard stuff for them. But then, in 2024, they kicked off this massive sell-off, doubling their cash in a single year. Fast forward to Q1 2026 today, and that cash position has ballooned to a whopping 59% of their investable assets. They've completely shifted from being aggressive owners to being massive savers. Now, it's important to realize this isn't just dead money stuffed under a mattress somewhere. As you can see in this breakdown, the vast majority, 85% of it, or about $339 billion, is very strategically parked in short-term U.S. Treasury bills. Actual cash and equivalents only make up about 13% of the whole shebang. And why does that specific strategy matter so much? Well, with interest rates hanging up there in the 4 to 5% range, those T-bills are quietly raking in roughly $39 million every single day in pure risk-free interest. That works out to roughly $14 to $17 billion a year just for waiting around. It totally changes the math. Holding cash used to mean losing out to inflation, but today, this massive yield practically eliminates the cost of waiting for the perfect deal. Moving right along to section 2, the valuation elephant. Let's take a look at clue number 2. To really see the market through Berkshire's eyes, you have to look at the Buffett indicator. Warren Buffett has championed this namesake metric for years as the absolute best single measure of where market valuations stand. It's super simple. You just take the total market cap of all publicly traded U.S. stocks and compare it to the entire U.S. GDP. Historically, the median for this indicator sits right around 120%. Buffett has famously warned that if it ever creeps toward 200%, investors are quite literally playing with fire. Well, look at where we are right now in July 2026. We are sitting at a terrifying, unprecedented 215%. According to their own core metrics, this market isn't just expensive, it is dangerously overvalued. And honestly, we see this story playing out everywhere. When you compare the historical average S&P 500 price-to-earnings ratio of 17.9 to today's bloated multiples sitting well over 30, it becomes crystal clear why Berkshire has hit the pause button. As Buffett recently noted, market prices for a whole lot of things look, in his words, very silly right now. They simply refuse to pay a massive premium for businesses that are priced for absolute perfection. All right, on to section 3, the Apple tax strategy. This is our third clue. Let's break down the math on this one because it is a brilliantly calculated move. First, Berkshire bought Apple at a very reasonable 15 times earnings, but they watched that valuation expand to nearly 40 times. Second, they shocked everyone by dumping over 75% of that beloved stake. Why? To lock in over $100 billion in previously untaxed gains. And here's the real kicker. They did it specifically to capitalize on today's historically low 21% corporate tax rate. Buffett explicitly stated he expects the government is going to have to raise tax rates to combat the national deficit, so they smartly locked in their gains while the tax penalty was still cheap. And this extreme defensive posture goes way beyond just Apple. Across the board, Berkshire has actually been a net seller of stocks for 13 consecutive quarters now, divesting over $174 billion in equity. They've even mostly halted their own stock buybacks. Why? Because even Berkshire's own stock is trading at a steep 60 to 80% premium to its book value. Sure, under Greg Abel, they briefly resumed a tiny $234 million buyback, but the overarching theme is strict, unwavering discipline. If there is no discount, they don't buy. Which brings us to Section 4, Economic Oxygen and Optionality. Let's see how this whole master plan ties together. It really all comes down to how Buffett views cash. He calls it economic oxygen. It's a crucial, non-negotiable survival tool. By holding on to nearly $400 billion, they are guaranteeing the company is protected from completely unanticipated events and systemic liquidity shocks. Think about it. When the rest of the financial world runs out of breath during a crisis, Berkshire Hathaway is sitting on an endless supply of oxygen. Now, of course, critics love to point out the opportunity cost here. They'll argue that by sitting in cash over the last few years, Berkshire theoretically missed out on roughly $125 billion of S&P 500 gains. But remember Buffett's absolute first rule of investing: don't lose. They are perfectly willing to endure a little short-term underperformance to ensure they never risk a permanent loss of capital in a wildly overvalued market. And if we look at history, this extreme patience almost always pays off. In 2008, Berkshire built up a massive $70 billion fortress of cash right before the financial crisis, allowing them to score incredible deals with companies like Goldman Sachs and GE. In 2020, they held $128 billion right before the COVID crash. And today, in 2026, they're sitting on $397.4 billion. Historically, building a massive cash reserve like this positions them perfectly to be the ultimate buyer of distressed assets when the next major market dislocation inevitably hits. So, what does this all mean for the rest of us? With nearly $400 billion locked and loaded in the safest assets on Earth, generating almost $40 million a day while they wait, we have to ask ourselves a serious question. Is Berkshire Hathaway just being paranoid and way too cautious? Or, with all these indicators flashing red, is everyone else in the market simply playing with fire? It's a fascinating mystery, and history suggests Berkshire is perfectly positioned to solve it. Thanks for joining me on this explainer, and definitely keep your eyes on that cash pile.